In the first week of November 1907, the financial system of the United States was saved in a private library on 36th Street in Manhattan by one man, acting with no legal authority whatsoever. The scene sounds invented, but every detail is documented. On a Saturday night, the presidents of New York's leading trust companies, the men who controlled hundreds of millions of dollars of other people's money, were summoned to a marble palazzo housing one man's book collection. They were shown into the East Room, beneath a ceiling of Renaissance splendor, and the negotiations began. When some of them balked at the terms, their host stepped out, and the great bronze-fitted door was locked. The key was in his pocket. Nobody was leaving until the papers were signed. Toward 5 in the morning, they signed. The host was John Pierpont Morgan. He was 70 years old, half-retired, sick with a cold, playing solitaire in an adjoining room while empires of credit trembled down the hall. He held no government office. He commanded no agency. There was no agency to command because in 1907, the United States of America, the largest economy on earth, had no central bank, no Federal Reserve, no deposit insurance, no lender of last resort of any kind. When the system hemorrhaged, there was no institution on the planet designed to stop the bleeding. There was only Morgan. And for 3 impossible weeks, that was enough. He decided which institutions would live and which would die. Literally, sorting the sick from the doomed like a battlefield surgeon. He summoned the presidents of the great banks into his office and extracted $25 million from them in a matter of minutes to keep the New York Stock Exchange from closing its doors. He organized the rescue of the city of New York itself, which was days from defaulting on its obligations. Clergymen were asked to preach calm from Sunday pulpits at his suggestion. The Treasury Secretary of the United States traveled to New York and, in effect, placed the federal government's own deposits at the disposal of Morgan's operation. The government was not directing the rescue. The government was contributing to it. It worked. The panic broke. The system held. By any reasonable measure, it was the most virtuosic performance in the history of American finance. And it frightened the country half to death because when the smoke cleared, Americans were left staring at what the crisis had revealed. The entire financial system of a continental republic had depended, for its survival, on the judgment, the health, and the goodwill of a single private citizen, a man whom no one had elected, whom no law constrained, and who would not live forever. The question that seized Congress was not the question you might expect. It was not, what if Morgan had failed? It was darker and stranger than that. What terrified them was that he had succeeded. If one man could stop a panic, one man held the power to permit one. If one man could decide which banks lived, one man was, functionally, the sovereign of American credit, a private government of money, accountable to nothing. Within months, Congress launched the investigations. Within 5 years, its hearings would drag the old man himself into a committee room to answer, under oath, for the empire he embodied. And within 6 years, after a secret meeting on a private island that participants would deny for decades, a train ride under false pretenses, and a legislative war, the United States would build the institution it had refused for 3/4 of a century, the institution designed to ensure that no library and no lion would ever be necessary again. This is the story of the Panic of 1907, the last crisis of America's wildcat century, the extraordinary man who ended it, and how the fear of that man, more than the fear of the panic itself, gave birth to the Federal Reserve. To understand any of it, you first have to understand something almost unbelievable about the world before. Why the richest nation on earth had no central bank at all, and why it had chosen, twice, to kill the ones it had. America's missing central bank was not an oversight. It was a tombstone. 2 tombstones, in fact, and the story carved on them explains the entire 19th century of American money. Twice in its early history, the United States built a national bank. Hamilton's Bank of the United States in 1791, and a second in 1816. Twice the institution became the most hated corporation in America, denounced as a monster of concentrated power, a machine by which Eastern financiers and their foreign shareholders would master the republic. The second bank died spectacularly in the Bank War of the 1830s, when President Andrew Jackson, who regarded central banking as everything the revolution had been fought against, vetoed its recharter in a message that still rings like a war drum, withdrew the government's deposits, and ground the institution into extinction by 1836. From that year until 1913, 77 years, the entire adult life of the Republic's rise to industrial supremacy. The United States operated without any central monetary authority whatsoever. It was a choice, made in fear of concentrated financial power, and held with religious firmness. Now watch what grew in the vacuum, because the architecture of 1907's catastrophe was assembled piece by piece across those decades. After the Civil War, the National Banking Acts gave the country a peculiar system. Thousands of individually chartered banks. There would be more than 20,000 by 1907, each an island issuing credit locally, with no institution standing behind any of them. The law arranged their reserves into a pyramid. Country banks were permitted to keep part of their required reserves as deposits in banks in designated reserve cities. Those city banks, in turn, kept part of theirs in the ultimate reserve city, New York. Follow the money to the top of the pyramid, and you find the mechanism of every Gilded Age panic. The idle cash of the entire nation pooled in a handful of Wall Street banks, and those banks, paying interest on it, could not let it sit idle, so they lent it where it could be recalled instantly, to the stock market as call loans. Overnight money financing speculators' margin accounts. The savings of a farmer in Kansas, deposited in Topeka, redeposited in Chicago, redeposited in New York, ended the day propping up a plunger's position in Union Pacific. The nation's reserve was a tower of borrowed stability standing on the most volatile asset market in the world, and the tower swayed with the seasons. Every autumn, the harvest moved and the country drew its cash home, millions in currency flowing west to pay for crops, draining the New York banks at the very moment the year's business peaked. Economists of the era called it the seasonal stringency. Every October, money tightened, interest rates spiked, and the system walked a ridgeline with no rope. The currency, tied by law to bond collateral rather than to the economy's needs, could not expand to meet the season, inelastic, in the era's favorite complaint. Most years, the walk was nervous but survivable. But if anything else went wrong in October, a failure, a scandal, a shock, the drained reserves had no cushion, and the pyramid's logic ran in reverse. New York squeezed the reserve cities, the cities squeezed the country, and every bank in America simultaneously demanded the same cash that did not exist. That is a financial panic, and the national banking era produced them with the regularity of a comet. 1873, 1884, 1893, each one freezing credit, toppling banks by the hundreds, and dumping the economy into depression. The Panic of 1893, the worst of them, shuttered some 500 banks and produced unemployment estimated in places at nearly 1 worker in 5. Each time the same debate flared, and each time reform lost to the ghost of Andrew Jackson. A central bank remained politically unspeakable. The memory of the bank war, refreshed by the populist crusades against the money power, made any concentration of monetary authority, public or private, the third rail of American politics. So the system improvised. The New York Clearinghouse, the private association through which the city's banks settled accounts, evolved into a shadow crisis manager, issuing emergency loan certificates in panics so members could settle without cash, examining and sometimes rescuing weak members, and when it chose, letting them fail. And above the clearinghouse, in the last resort, stood not an institution but a man. By 1907, John Pierpont Morgan had performed the role before, on the grandest possible stage. In 1895, in the depression that followed the panic of 1893, the gold reserve of the United States Treasury itself had drained toward the vanishing point. The government of the United States, on the gold standard, running out of gold with default weeks or days away. President Grover Cleveland, out of options and knowing the political price, turned to Morgan. In a White House meeting that has entered legend, Morgan, reportedly citing a forgotten Civil War statute as legal cover, organized a private syndicate with the Rothschild interests to supply the Treasury with gold, roughly $65 million of it, half from Europe, and to use the syndicate's power over the foreign exchanges to hold the gold in place. It worked. The government was saved, and the political system promptly demonstrated the impossible position of its savior. Cleveland was savaged by his own party for kneeling to Wall Street. Bryan's crusade the following year ran, in spirit, against that single meeting, and Morgan, who regarded the operation with pride as a patriotic act, and had profited from it besides, learned that in America, the reward for privately rescuing the public credit was to become the chief exhibit of everything the public feared. Hold that lesson. 12 years later, the entire drama would be restaged, at 10 times the scale, with the same star and the same reviews. So this was the stage in the autumn of 1907. A banking system with no center, wound tight by its own architecture, entering the annual October squeeze. A treasury with no tools beyond shifting its deposits. A clearinghouse that protected only its members. And one aging private citizen who had, by force of record and personality, become the system's unwritten constitution. All that was missing was the match. The match, when it came, was one of the shabbiest episodes in Wall Street history, a botched stock corner by a copper country chancer and his circle, men whom the great bankers regarded roughly as a duchess regards a pickpocket. The Panic of 1907 did not begin among the mighty. It began among the gamblers, and then it burned down the neighborhood of institutions that had quietly become the most dangerous in America, the trust companies. To understand why the fire spread the way it did, you need to meet the era's shadow banks, because 1907 was, at its core, the first great shadow banking crisis in American history, and the pattern it set would repeat, almost line for line, a century later. The trust company had begun in the 19th century as exactly what its name suggests, a state institution managing estates and trusts for the propertied, but its charter was a loophole with a marble lobby. Trust companies could take deposits like banks. Yet in New York they faced far lighter reserve requirements than national banks, and they stood outside the clearinghouse's discipline. Lower reserves meant higher profits, meant higher interest on deposits, meant explosive growth. In the decade before 1907, trust company assets in New York roughly tripled, growing far faster than the banks, until the trusts collectively rivaled the national banks of the city in size. They lent aggressively against real estate, against securities, and to the market's speculative reaches where conservative banks feared to tread. They were, functionally, banks. Bank-sized, bank-fragile, run-prone. They simply lacked the two things that made bankhood survivable: thick reserves and membership in the club that would save you. When depositors ran on a national bank, the clearinghouse machinery stood behind it. When depositors ran on a trust company, behind it stood the wallpaper. Nobody planned this. It is simply what money does. It flows around regulation the way water flows around stone, pooling wherever the rules are thinnest, and the pool deepens until someone tests the bottom. Remember this design flaw when we reach 2008, because the institutions will change their names. Trust company, investment bank, money market fund, and the flaw will not change at all. Political weather mattered too, and it blew from Washington. Theodore Roosevelt had spent 1907 in open rhetorical war with what he called the malefactors of great wealth, and Wall Street returned the sentiment with interest, blaming the year's sliding markets on his prosecutions, his regulatory crusades, and a summer of presidential speeches that the financial district read as incitement. The mutual recrimination became its own historical debate. Conservatives at the time insisted the panic was Roosevelt's doing, a crisis of confidence manufactured by trust-busting. Roosevelt retorted that the speculators had built the powder magazine themselves, and were now blaming the man who warned about matches. Modern scholarship assigns the causes elsewhere, as we are about to see, but the poisoned atmosphere is part of the story's machinery, because it meant the two powers that would have to cooperate in the emergency, the White House and the street, entered October 1907, despising each other. That both swallowed it. Roosevelt's treasury funding Morgan's operation. Morgan's emissaries at Roosevelt's breakfast measures how frightened everyone became, and how completely, in the absence of institutions, the Republic depended on its antagonists, improvising a truce. There had been warnings, one of them almost eerily specific. Paul Warburg, the German-born partner at Kuhn, Loeb, who had grown up inside Europe's central banking traditions, had been telling anyone who would listen that America's decentralized reserve system was a fire waiting for a season, publishing at the start of 1907 a plan for an American institution modeled on the great European banks of issue. And the veteran banker Jacob Schiff had declared in a widely quoted 1906 speech, in substance, that unless the currency was reformed, the country would suffer a panic beside which all previous panics would look mild. The establishment nodded and filed the warnings where establishments file them. Within 2 years, Warburg would be drafting the remedy on a secret island. The prophets of 1906 became the architects of 1910. Keep their names. The ridicule to Rotunda Arc is one of this era's purest specimens. One more force was pressing on the system in 1907, and it had arrived from the strangest direction imaginable. Underground from California, the year before. On April 18, 1906, the San Francisco earthquake and fire destroyed one of the great cities of the Pacific, and with it detonated a financial chain reaction that modern scholars have traced, link by link, into the panic. San Francisco was insured to an extraordinary degree in London. The catastrophe forced British insurers to ship gold across the Atlantic in one of the largest sudden capital transfers of the era, draining the reserves at the system's global center. The Bank of England responded as central banks on the gold standard must. It defended itself, raising its rate sharply through late 1906 and pointedly discouraging the London market from financing American paper. The effect was a worldwide tightening of credit through 1907, money dear on every continent, markets sliding for months before October, distress flaring from Egypt to Hamburg to Chile. America thus entered its most dangerous season, the autumn crop-moving drain, already squeezed from abroad, its usual London lifeline deliberately shortened because a city had burned 18 months earlier. It is one of history's cleanest lessons in how interconnected the gold standard world already was. The fault line that broke in California ran, through insurance ledgers and bank rates, all the way to the door of the Knickerbocker Trust. When people imagine financial globalization as a modern invention, 1907 is the correction. Now the match. His name was F. Augustus Heinze, and he arrived on Wall Street in 1906, trailing one of the great buccaneering fortunes of the age. Heinze had made his name, and his money, reportedly some $10 or $12 million, in the copper wars of Butte, Montana, where for a decade he had tormented the mighty Amalgamated Copper Combine, the Rockefeller Allied Trust, through a genius for litigation. Friendly local judges, ingenious mining law claims, and a swagger that made him a folk hero to miners and a menace to monopolists. When the giants finally paid him to go away, Heinze took his winnings east to become a banker, buying into a chain of banks alongside a smoother and more dangerous operator named Charles W. Morse, a Maine ice magnate whose control of New York's ice supply had already produced one memorable scandal, and who now practiced the era's dark art of chain banking, using the deposits of each acquired bank to finance the acquisition of the next. In October 1907, Heinze's brother Otto conceived the scheme that lit the fuse. The Heinzes held a large position in the stock of their family company, United Copper, and Otto became convinced that short sellers had borrowed and sold more shares than actually existed to borrow. If the Heinzes bought aggressively and then demanded delivery of their loaned shares, the shorts would be trapped, forced to buy back at any price the Heinzes named. A corner, the oldest, most brutal play in the speculative repertoire. On Monday, October 14, they struck, and United Copper leaped from the high 30s towards 60 on the curb market. The outdoor exchange then literally conducted on the pavement of Broad Street. For a day it seemed to work. It had not worked. Otto had miscounted. The shorts found shares in plentiful supply, delivery was met, the corner's jaws closed on nothing, and on Wednesday, October 16, United Copper collapsed from 60 toward 10. The brokerage carrying the scheme failed. Otto was ruined. And now the fire found the structure Heinz and Morse had built. Because every depositor in New York could read a newspaper. The man whose corner had just detonated was president of the Mercantile National Bank. The line formed at the Mercantile immediately. The clearinghouse stepped in, support in exchange for surgery. Heinz out, Morse and his whole chain purged from banking. By the weekend, the clearinghouse had effectively quarantined the infection among its members, announced the cleansing, and pronounced the trouble contained. It was the correct treatment for the wrong disease. Depositors had not been reassured. They had been educated. They had learned that behind respectable marble facades might stand men like Heinz and Morse, and they began asking the fatal question about every institution holding their money. Who else? The question found its answer not among the banks, but next door, in the biggest and proudest of the shadow institutions. A trust company whose president belonged to the Morse Circle. The Knickerbocker Trust Company was no boiler room. It was the third largest trust in New York. Roughly $65 million of deposits, 18,000 depositors, housed in a Fifth Avenue temple with Corinthian columns, catering to society itself. Its president, Charles T. Barney, was a fixture of that society. He was also, the newspapers now reminded everyone, an associate of Charles W. Morse. Whether the Knickerbocker had actually lent into the copper scheme mattered less than the arithmetic of fear. This was a bank-sized institution with trust company reserves, and its president knew the wrong people. On Monday, October 21, the Knickerbocker's own directors, hoping to lance the boil, forced Barney's resignation, and the National Bank of Commerce announced it would no longer clear the Knickerbocker's checks. The announcements meant to calm depositors read to depositors as confirmation. The run began. Tuesday morning, October 22, 1907, belongs in any anthology of American scenes. Fifth Avenue at 34th Street, automobiles of the wealthy double parked, a line of depositors stretching down the block, society matrons, businessmen, messengers sent by the prudent rich, pressing through bronze doors into a banking hall where tellers, on instruction, paid out slowly, counting small bills at a funereal pace while the pile of withdrawal slips grew. In under 3 hours that morning, Knickerbocker paid out roughly $8 million. Shortly after noon, it stopped. The word moved down the line, and down the avenue, and down the island. The Knickerbocker Trust has suspended. One block of that story requires honest telling, because it is the panic's most debated decision. In the desperate hours before suspension, the Knickerbocker's fate had been laid, like everything else that month, at the door of J. Pierpont Morgan. Morgan had returned to the city from a church convention in Virginia, summoned, extraordinary as it sounds, by partners who understood that no rescue of anything could proceed without him, and had begun assembling his general staff, including a cool-eyed young bank examiner named Benjamin Strong, dispatched to tear through the Knickerbocker's books overnight, and answer the only question Morgan recognized. Not is it big, not is it beloved, but is it solvent. Strong could not get to an answer in the hours available. The books were too tangled, the time too short, and without the answer, Morgan would not move. No certification, no rescue. The Knickerbocker was allowed to fall. Judge that call as you like. Its architects defended it as triage, and its critics have called it the error that turned a fire into a firestorm, because the Knickerbocker's fall detonated the general panic, transforming who else from a question into a stampede. But mark what happened at the next threshold, barely 24 hours later, because it reveals the method of the whole rescue. The run leaped to the Trust Company of America. Larger questions, bigger institution, and this time Strong got through the books in time, emerging from a night of ledgers to report to the library. Strained but solvent. Morgan, by the accounts of the men in the room, announced that this, then, was the place to stop the trouble, and the machine engaged. Cash from the big banks, collateral hauled physically through the streets in satchels. The Trust Company of America paid out and did not close that day or any day after. The doctrine in that decision would be given a name in a textbook by the economist Walter Bagehot's British admirers, but Morgan was practicing it live, without the textbook's lender of last resort to command. Let the insolvent fail, lend freely to the solvent, and make the lending visible enough to break the fear. What no one man could supply, however, was enough cash for everyone at once. And now the whole October architecture came down together. Country banks, reading the New York headlines, clawed their reserves home. The pyramid ran in reverse on schedule. Call money on the stock exchange, the overnight lifeblood of the market, spiked toward triple-digit annual rates and then simply ceased to exist at any price. On Thursday, October 24, the president of the New York Stock Exchange crossed Broad Street to Morgan's office to say that without immediate millions, the exchange could not stay open until its 3 o'clock close. Dozens of brokerage houses would fail within the hour. What followed became the panic's signature legend, and it is documented fact. Morgan summoned the presidents of the great national banks to his office, and in a matter of minutes, extracted pledges of $25 million. The money reaching the exchange floor to an eruption of cheering that traders claimed to remember for the rest of their lives. The next day, the market needed rescuing again. Morgan raised nearly $10 million more, this time dictating terms against margin lending. That same week, learning that the city of New York itself, unable to float its bonds in a dead market, was days from failing to meet obligations, Morgan sat with the mayor and simply bought the problem. The syndicate took $30 million of city bonds. The United States Treasury, for its part, did what little the law allowed. Secretary George Cortelyou came to New York and deposited tens of millions of federal money into the national banks, placing the government's cash, in effect, into the reservoir that Morgan's operation was directing. John D. Rockefeller, the richest man alive, deposited millions into the trusts and announced publicly, in substance, that he would pledge half his fortune to maintain America's credit. Note the direction of every arrow in that sentence. The government supporting the banker, the richest man supporting the banker, the constitutional order of the republic arranging itself for 3 weeks around a private library. And beyond Manhattan, the country was discovering what the top of the pyramid seizure meant at the bottom, because the panic of 1907, remembered as a New York drama, was lived by most Americans as something more elemental. The money simply stopped. As interior banks hoarded and New York restricted, banks across the nation suspended or rationed cash payments, not failing, merely refusing to hand over currency, and the United States entered weeks of what contemporaries called a currency famine. Clearinghouses in dozens of cities issued emergency certificates that circulated as money. Employers paid wages in scrip, in checks nobody could cash, in due bills good at the company store. Cash itself commanded a premium brokers openly paid above face value for currency, dollar for dollar plus a fee, one of the strangest price quotations in American history. Money selling for more than money. Estimates of the substitute currency improvised that winter run into the hundreds of millions of dollars. A spontaneous, technically illegal, universally tolerated national experiment in making money up. Commerce slowed to the pace of barter in places. Fall settlements were postponed, and the episode seared itself into the memory of every merchant and banker who lived it. When Congress moved within months to legalize emergency currency, it was not being visionary. It was ratifying what 10,000 desperate towns had already done. Sunday cameos completed the surreal picture. At Morgan's instance, clergy across New York preached confidence from their pulpits that weekend, and the press was managed with equal care. The panic was being fought on every front a government would fight it on: liquidity, solvency, communications, morale, by a government that did not exist improvised nightly among the Renaissance manuscripts of one man's collection, and it very nearly held. By the first days of November, the acute runs were subsiding. Then came the last mine in the harbor, the one that produced the locked door, the all-night siege in the East Room, and a deal whose price tag was paid not in dollars but in the antitrust policy of the United States, negotiated over a president's breakfast while the market counted the minutes. Before the final act, stop and look at the man at the center of it, because by now he has been directing traffic for 2 weeks, and we have not properly met him. John Pierpont Morgan in 1907 was 70 years old and had spent roughly half a century becoming the most formidable figure in world finance, not the richest, a distinction that mattered to him. When his estate was finally tallied, John D. Rockefeller is said to have remarked, in substance, that Morgan had not even been a wealthy man. Morgan's power was of a different species than wealth. He was the great organizer, the man who took the chaos of competitive capitalism and imposed structure on it, whether it wished to be structured or not. He had reorganized so many bankrupt railroads that the process bore his name. Morganization, creditors assembled, capital restructured, and a Morgan partner installed on the board to keep the peace. He had assembled General Electric. In 1901, he had built United States Steel, the first billion-dollar corporation on earth, buying out Andrew Carnegie with a handshake figure scribbled on a slip of paper. His firm at 23 Wall Street, the corner, men called it needing no address, sat at the center of a web of interlocking directorships that a congressional committee would soon map with horrified fascination. The physical man matched the legend uncomfortably well. Massive, glowering, with hawk's eyes that one famous photographer said made portraiture feel like staring into the headlight of an oncoming train. Morgan carried a disfigurement that shaped his bearing, rhinophima, a condition that swelled and empurpled his nose grotesquely, which he refused to have treated and dared the world to mention. He spoke little, decided fast, and held 2 convictions with granite certainty: that his own judgment was sound, and that character, not collateral, not balance sheets, character was the foundation of all credit. He would say exactly that, under oath before hostile congressmen in the last winter of his life, and he was not, by 1907, primarily a banker in his own mind. He was a collector, one of the most voracious in the history of art. Gems, manuscripts, old masters, the treasures of dismantled European collections flowed to him in freight loads. And to house the manuscripts he had built next to his brownstone on 36th Street, the building where this story climaxes. The Morgan Library, completed in 1906, a Renaissance palazzo by the architect Charles McKim, its marble blocks fitted in the ancient Greek manner without mortar, its interior a jewel box of tapestries, frescoed ceilings, and 3 tiers of inlaid bookcases holding Gutenberg Bibles and the autographed manuscripts of Milton and Dickens. It was the sanctum of a private emperor. In the first week of November 1907, it became, in fact, if never in law, the central bank of the United States. For those 3 weeks, the city watched him the way a ship's passengers watch the captain in a storm. Crowds gathered when his cab passed. Reporters camped at the library steps around the clock, parsing the arrivals and departures of financiers, the way diplomats parse troop movements, and the newspapers, with no central bank to covered the man, his cold, his cigar, his hours, as the nation's de facto financial bulletin. The scene the correspondents could not get past, and neither can history, was the solitaire. Through the worst nights between conferences, witnesses describe Morgan alone at a card table in the West Room under the gaze of his Madonnas, laying out game after game while men waited beyond the door for decisions that would decide their institution's existence. Interpreters have made of it what they wished: iron nerve, or the ordering ritual of an old mind arranging chaos into suits and sequences. Perhaps it was simpler. Everything in that library, from the mortarless marble to the locked bronze door, expressed one man's lifelong conviction that disorder was the enemy and that someone must impose the pattern. For 3 weeks, the pattern was imposed nightly, over cards, at the center of the storm. The final crisis arrived through a side door, as final crises do. A major brokerage house, Moore and Schley, was discovered to be leaning on the edge. It had borrowed enormously against the stock of the Tennessee Coal, Iron and Railroad Company, and in a market where nothing could be sold, its lenders were calling. If Moore and Schley collapsed on Monday morning, the whole exhausted structure could go with it. At the same time, and this is why that first weekend of November became a siege, the trust companies were still bleeding, and the trust presidents had so far hung back from organizing their own collective defense, each hoping the crisis, or Morgan, would spare him individually. Morgan's solution fused both problems into a single, breathtaking transaction. United States Steel, his creation, would acquire the Tennessee Company outright, exchanging Moore and Schley's frozen collateral for gold-plated U.S. steel bonds, instantly rescuing the brokerage. The trust presidents, meanwhile, would at last be compelled to raise a common fund of $25 million to stand behind their own weakest members. Both agreements were extracted in the library over that famous weekend. The trust presidents assembled Saturday night, November 2, in the East Room, conferring among the tapestries while Morgan sat apart in the West Room study playing solitaire. And when the hesitation had gone on long enough, the door was locked and the key pocketed. The scene has been told by men who were there, including Benjamin Strong, who recorded arriving to find the doors sealed and the greatest names in New York finance held, in the politest possible sense, captive. In the small hours, Morgan walked into the East Room, placed the subscription papers before the leader of the trust company men, and by Strong's account, closed the matter with a hand on the shoulder and the pen physically presented. "Here is the place, and here is the pen." They signed. It was nearly 5 in the morning, one signature remained, and it did not belong to any banker. United States Steel already commanded a majority of American steel production. Its acquisition of a major Southern competitor was, on its face, precisely what the Sherman Antitrust Act existed to prevent, and the President of the United States was Theodore Roosevelt, the trustbuster himself, the man who had built his legend prosecuting Morgan's own Northern Securities Railroad combined 4 years earlier. Announce the Tennessee deal Monday morning and invite a federal suit, and the rescue would detonate the market it was meant to save. So on Sunday night, November 3, 2 of the loftiest figures in American industry, Elbert Gary, chairman of U.S. Steel, and Henry Clay Frick, boarded a special overnight train to Washington, racing the opening bell. They reached the White House on Monday morning and were ushered in to see Roosevelt before 10 o'clock, interrupting his breakfast hour with the market minutes from opening. They laid out the transaction, characterizing it carefully as a reluctant civic duty of little commercial benefit to Steel, and asked, in effect, whether the government would object. Roosevelt, briefed on the abyss and given no time to consult anyone, indicated, in the language he later confirmed to his Attorney General, that he saw no public duty to object. Word reached New York by wire moments before trading began. The market told that U.S. Steel would absorb the Tennessee Company with the White House's tacit blessing, turned. The panic of 1907, as an acute event, ended that week. Every element of the modern debate about financial rescues is present in that breakfast, fully formed. A systemically vital deal, priced in regulatory forbearance. A president deciding in minutes on the petitioner's own description of the facts, with the market as a hostage clock. A dominant corporation acquiring a competitor at what critics would forever insist was a fraction of its worth. The Tennessee Company's coal and iron lands would be valued by later partisans at fantastic multiples of the purchase price, a claim itself endlessly disputed. Roosevelt would spend years defending that morning. His chosen successor, William Howard Taft, would repudiate it in the most concrete way possible. His administration's 1911 antitrust suit against U.S. Steel named the Tennessee acquisition among its counts, a suit Roosevelt took as a personal accusation of gullibility, or worse. The resulting rupture between the two men helped split the Republican Party in 1912, throw the presidency to Woodrow Wilson, and thereby place into power the party and the president who would sign the Federal Reserve into law. Follow that chain and savor it. The deal that ended the panic broke the friendship that split the party, that elected the man who signed the act that ensured no such deal would ever be needed again. History does not often tie its own bows so neatly. The human ledger of the panic closed with entries the financial ledger omits. Charles Barney, the deposed Knickerbocker president, shot himself at his home in November, insisting to the end that his trust had been solvent, and in the bitter epilogue that became a Wall Street parable, the Knickerbocker eventually resumed payment. Its depositors, in time, were made whole. Heinze and Morse were prosecuted. Morse went to federal prison and secured early release through a medical deception involving self-induced symptoms that became a scandal of its own. The economy paid the widest price. The panic tipped an already slowing economy into a sharp, deep contraction through 1908. Production down brutally. Unemployment multiplied. The suffering, as always, landing furthest from Wall Street. The rescue had saved the system. Nobody claimed it had saved everyone in it. And then came the reckoning that gives this story its title. Because official Washington had watched the whole performance and drawn its breath, the first official response came within months, and it was a confession wearing the costume of a law. The Aldrich-Vreeland Act of 1908 authorized banks, in future emergencies, to form associations and issue emergency currency against securities. In effect, it legalized and nationalized the improvisations of 1907, so that the next panic could be fought with printed law instead of borrowed genius. Congress knew it was a patch, and said so in the statute itself, which created something with a modest name and immodest consequences. The National Monetary Commission, chaired by Senator Nelson Aldrich of Rhode Island, charged with studying the banking systems of the world and recommending, at last, a permanent architecture. Aldrich was the Senate's master of finance, and his critics never tired of noting, the very embodiment of the Eastern establishment. His daughter had married John D. Rockefeller, Jr., which made the senator, by marriage, grandfather to the Rockefeller line. The commission produced shelves of studies. And then, in November 1910, it produced something else. The episode that conspiracy literature has feasted on for a century, and which needs, precisely for that reason, to be told here with documentary care, because the documented version is strange enough. That month, a private railcar left Hoboken, New Jersey, at night, its blinds drawn, carrying a party of men who had arrived separately, dressed as duck hunters, under instructions to address one another by first names only, so that the porters could not report the surnames. The destination was Jekyll Island, Georgia, a private club island whose membership held a spectacular share of American wealth. The party included Senator Aldrich, his aide, the economist A. Piatt Andrew of the Treasury, Frank Vanderlip, president of National City Bank, the largest bank in the country, Henry Davison, senior partner of J.P. Morgan and Company, Paul Warburg of Kuhn Loeb, a German-born banker who had spent years as America's most learned evangelist for central banking, and by most accounts, Benjamin Strong, the same Benjamin Strong who had audited the dying trusts by lantern light 3 years earlier. For roughly a week to 10 days, in the seclusion of the club, these men drafted a complete plan for an American central banking system. None of this is speculation. The participants themselves confirmed it decades later. Vanderlip wrote candidly in the 1930s that they had traveled in secrecy worthy of conspirators, and that if their gathering had been exposed, the plan would have had no chance whatsoever in Congress. The secrecy, in other words, is not the theory. The secrecy is the admitted fact, and the reason for it is the most revealing fact of all. The men drafting the reform understood perfectly that its association with themselves would kill it. In post-1907 America, the surest way to destroy a banking reform was to reveal that bankers had written it, which is exactly what happened, twice, in opposite directions. The Aldrich Plan, unveiled in 1911 with its Wall Street fingerprints imperfectly wiped, proposed a National Reserve Association, a central institution, holding reserves, issuing elastic currency, governed substantially by the banks themselves. Progressives and Democrats fell on it precisely as Vanderlip had feared, a money trust charter, Jekyll Island's ghost visible through the drafting. It died. But its machinery did not, because when the Democrats swept to power in 1912 and took up banking reform under Wilson, Congressman Carter Glass and the president reworked the architecture. Not one central bank, but a dozen regional reserve banks. Above them, not a banker's board, but a public Federal Reserve Board, appointed by the president, the currency and obligation of the United States. The bankers' plan, publicly buried, was substantially reincarnated with a public head grafted on, a hybrid of private structure and public control that satisfied almost no one completely, which may be the most American possible birth for a central bank. The Federal Reserve Act passed just before Christmas, and Wilson signed it on December 23, 1913. 77 years after Jackson's victory, the United States had a central bank again, conceived in a panic, drafted on a secret island, killed as a banker's bill, and resurrected as a public one. Between the island and the act, Congress staged the reckoning with the man himself. Through 1912, the Pujo Committee, Counsel Samuel Untermeyer presiding over the questioning, conducted the famous money trust investigation, mapping with subpoenas what everyone sensed and no one had quantified, the web of interlocking directorates through which the Morgan Circle and its allies held seats, hundreds of them, across the commanding heights of American banking, railroads, insurance, and industry. Influencing corporate resources, the committee totted up in the tens of billions. And in December 1912, the committee summoned Pierpont Morgan. The old man, months from death, though no one knew it, traveled to Washington and sat, massive and courteous, through hours of Untermeyer's precise needling. The exchange everyone remembers came when Untermeyer pressed him on whether credit rested, at bottom, on money and property. Morgan's answer, preserved in the transcript and quoted in every history since, was that it did not, that the first thing was character, and that a man he did not trust could not get money from him on all the bonds in Christendom. It was the creed of the entire vanished world this series has been describing. The storekeeper's ledger, the country banker's 3 C's, the whole civilization of personal credit, pronounced by its emperor, under oath at the exact moment history was replacing it with institutions, examinations, and law. The committee's report landed in early 1913 and became a founding text of American financial reform. The Federal Reserve Act and later the securities laws all carry its fingerprints. Morgan sailed for Europe soon after testifying, declined visibly. Intimates insisted the hearings had broken something in him, and died in his sleep at the Grand Hotel in Rome on March 31, 1913, 9 months before the act that institutionalized his role was signed. On the day of his funeral, the New York Stock Exchange closed. Wall Street flew flags at half-staff for a private citizen. And the first governor of the new Federal Reserve Bank of New York, the operating heart of the new system, was Benjamin Strong, the young examiner from the Library Knights, who would run it until his death in 1928 and become, in the judgment of many scholars, the most consequential central banker of the century's first half. The apostolic succession could not have been plainer. The office Morgan had held by force of character passed, by statute, to the man he had trained in it. Did the new machine work? The honest answer is the uncomfortable one. Not at first, catastrophically not. The Federal Reserve's early decades included its supreme test, the contraction of 1929 to 1933, and it failed that test, standing by, for reasons scholars still dissect, while the banking system suffered exactly the cascading collapse it had been built to prevent, on a scale that made 1907 look like a rehearsal. Friedman and Schwartz's famous verdict that the Fed's passivity converted a recession into the Great Depression carries a bitter subplot for our story. Benjamin Strong had died in 1928, and a school of interpretation going back to his contemporaries holds that had Strong lived, the library's doctrine, lend freely, act fast, break the fear, would have been applied and history would read differently. It is unprovable and endlessly debated, but it underlines the deepest irony of 1907. The panic proved the system could not depend on one man. The Depression suggested that, for a while longer, it still did, the machine learned. Deposit insurance in 1933 ended the classic retail bank run in America almost overnight. The queues on the sidewalk, the defining image of a century of panics, simply stopped forming. The Fed grew into its role across the century until, by its later crises, it had become the most powerful economic institution on earth. And then, in 2008, history staged its rhyme with a precision that unsettled even the historians. Once again, the crisis erupted not in the regulated banks, but in the shadows beside them. Investment banks, money funds, and vehicles that were bank-sized and bank-fragile without bank protections, the trust companies reincarnated. Once again, a stricken giant was rescued over a sleepless March weekend by its acquisition at a distressed price. Bear Stearns, absorbed with official blessing and public support by the bank that carries the name of this story's protagonist, J.P. Morgan Chase. Once again, authorities let one institution fall, Lehman Brothers, and watched the fall detonate the general panic, restaging the Knickerbocker question for a new century of scholars to argue. The men in those rooms knew their history. Some cited it. The rooms had changed. The Marble Library exchanged for the Federal Reserve's boardroom, and that exchange is precisely what 1907 built. The judgment calls were the same calls. They were simply being made, at last, by people the public had some claim on. So return, finally, to the terror in this story's title, and notice that Congress was afraid of exactly the right thing. The peril revealed in 1907 was never really the panic. Panics were familiar. The revelation was that the Republic had outsourced a sovereign function, the power to decide, in extremis, who lives, to whatever private person happened to be equal to it. In 1907, that person was equal to it, and this was the frightening part. Benevolent, competent, 70 years old, and mortal. Power adequate to save a system is power adequate to own one, and a free people cannot found its survival on the hope that such power stays benevolent, stays competent, and never dies, or never has an heir less scrupulous. The Federal Reserve? Whatever else it is, and a century of argument attests that it is many things to many Americans, is the answer to that specific fear. The locked library door, rebuilt in public marble, with the key held, however imperfectly, by institutions instead of a man. And yet the old question refuses to die with the old man, it only changes address. Who watches the discretion? A private titan answered to nothing but his conscience. A public central bank answers to appointment processes, mandates, and oversight, and its critics, from its birth to this morning's news, have asked whether that answer is real or ornamental, whether the island's ghost still walks the marble halls, whether power over money can ever truly be domesticated or only relocated. The debate is not a flaw in the system. The debate is the system, the permanent, healthy refusal of a democracy to stop interrogating whoever holds the key. In 1907, for 3 weeks in November, the key sat in the pocket of one old man playing solitaire beneath a Renaissance ceiling, while the American financial system waited in the next room. Everything built since, every statute, every board, every mandate and hearing and confirmation fight, is the Republic's long attempt to make sure that never again would so much depend on the character of a single human being. Whether it has succeeded is a question each generation answers in its own crisis. The library, by the way, still stands on 36th Street. You can visit. The East Room is smaller than the country it once held. If you enjoy uncovering the forgotten systems, people, and decisions that shaped the modern world, subscribe for more documentaries like this. Thank you for watching, and I'll see you in the next one.